Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we're going to continue with our discussion on some of the main benefits of having a retirement income plan prepared. So today we're going to talk about the whole area of tax planning or tax forecasting. So when we rank order key priorities for people when they're looking at their retirement planning and their cash flow, one of the things that comes up consistently is I don't want to pay more tax than necessary. What are the planning opportunities so I can minimize the tax burden and make my money go further? So we're going to talk about three key strategies that the retirement income plan will really provide clarity on as you begin to plan for your retirement. So you'll enjoy this video. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on various aspects of retirement planning and wealth planning. So if you don't want to miss future content, make sure you hit subscribe. And if you like this video, hit like. Okay, let's take a look at how we get tax planning clarity and actually opportunity planning as it relates to the whole area of taxes and reducing our tax burden through the retirement years. So the first area we're going to talk about relates to forecasting and seeing how our income might change over time when we get things like Canada Pension Plan, Old Age Security, other sources of income. Are there opportunities we can exploit based on the forecasts that the retirement income plan is providing? Now, before we look at the retirement income planning report, which will give us guidance on some income splitting or tax planning opportunities, what I want to just show you is a chart that just goes over the major tax brackets. So to make it really practical for you, as we go into 2022, you're at the lowest marginal tax rate federally on income up to $50,197. Obviously, you'll have your personal exemption amount that's not taxable, but over and above that, your income's taxable. It's taxed at 15%. If you look at income between $50,197 to $100,392, the rate of tax is 20.5%. On income over $100,392 to $155,625 of taxable income, you're taxed at a rate of 26%. Now that's basically the federal rate, and then you take half of that, and for the most part that's a good average to use, and you'll add the provincial rate. But suffice it to say, we'll look at these three brackets in my example that I'm going to show you right now. So can we exploit these three different tax brackets in our retirement income plan? So let's take a look at a chart that sort of explains how to exploit the tax brackets. Now, what this picture is the different tax brackets, the brackets that I just showed you. So you've got the lowest rate, you've got the next rate, and then this rate, and of course there's rates above that. But let's look at the three major rates. Now, often when we take a look at taxable income through the retirement years, we sometimes see these anomalies where somebody will be at a certain tax rate, let's say at the middle to lowest rate, and then when their Canada Pension Plan and Old Age Security benefits begin to kick in, so they have their basic pension income and they're going along, and all of a sudden their government benefits kick in, you can see that the taxable income noted by this red line starts creeping up and actually creeps up into the next tax bracket. And then sometimes you'll see people actually bumping into an even higher bracket. So at age 71, that's when you have to take all your RSP capital and turn it into a registered retirement income fund, and then the first payment's required in your 72nd year. And for some people, that does bump them a bracket. And so again, you can see that they're tootling along, government benefits kick in, their income goes up, and then down the road, let's say they didn't need their RSP capital, so they were deferring it, and you can see their income now is being pushed into another tax bracket. Okay, so when we do a retirement income plan, that's one of the things that the plan's going to show you, and then you can plot out and forecast where you're landing on the tax brackets if you just employed a more traditional strategy around how you're going to generate income. So let's look at an example from the retirement income planning report. Now, what you see here is a great chart. This comes from the retirement income planning report, and what it does is that it plots your Canada Pension Plan, Old Age Security, any income coming from your RSP or RIF, pension income, employment income, tax-free savings account, and then the dotted line is the level of tax that you're paying. So what you can see here is if I just look at Old Age Security, there it is there. Look at CPP, there it is there. I look at my RSP capital, there it is there. And then the other sources of income. Now, you can see here that as we go along through this chart, you've got this dotted line which is taxation. And you can see that there is this decline in the taxation on the income, and then it starts going up again, and it's fairly constant over the years. Now this is an example, but what this is telling us is that there is a drop in their marginal tax rate, and it's at that point that you would recommend that the client goes into their registered capital and bring up their taxable income. So when we provide a report for a client, what we'll do is just plot all that income, see where it lands you on the marginal tax rate, and sometimes what you see is that even if someone doesn't need the income, it would make sense to draw the income from the RSP account earlier, expose it to a lower rate of tax, and maybe just reinvest it back to their tax-free savings accounts or their non-registered assets, and have it accumulate that way, as opposed to leaving the money in the RSP account, growing on a tax-deferred basis, and then maybe coming out at a higher marginal tax rate. It can also be a reason why it could make sense for some people to take Canada Pension Plan early. Might as well draw that money earlier if your marginal tax rate's lower, to smooth out that tax burden over time. Okay, so that's one benefit of the retirement income plan. We can begin plotting out where you're going to land on the marginal tax rates, and there may be an opportunity to draw income earlier to expose it to a lower rate of tax. Okay, so that's opportunity number one. Now, opportunity number two relates to simply just pension splitting. Now, when it comes to retirement income planning, for those people who are not yet retired, sometimes they're not aware of this. Obviously, most people who are retired are aware of the opportunity to pension split. They can take income from their pension plan and push it across to their partner on their tax return, and income split that way to reduce the total tax burden to the family. So as you're planning your retirement, if you're building up pension benefits through work, or if you have money obviously in your RSP account that's going to be in a registered retirement income fund at some point, you have the ability to move up to 50% of the income being taken from your pension plan or your RIF account can be moved to your spouse or partner. So before we finish off the last two ways that the retirement income plan can give you clarity on your tax planning through your retirement years, just want to alert you to the fact that we've got links that will take you to our resource page on our website. And this particular page will talk about how you can get a retirement income plan. As well, we have some other resources in this pop-up. You'll see Get Clarity, 5 critical questions your retirement income plan will answer. It's a 5-part video series. You can sign up for that as well. So take a look at those links, grab those resources. They're a very helpful bundle to give you education and information to help you with retirement income planning. Okay, let's get back to the video on how income planning can assist you with tax planning strategies. And that allows you to equalize your incomes more appropriately or more beneficially, so you don't pay as much tax as a family. Again, when we do a retirement income plan, we can figure out what is the optimized level of income that you would be pushing from a tax standpoint to your spouse or partner to reduce the taxes. So it's good to know what that number is going to be, and sometimes it's helpful to know that as you begin to plan your taxes. Okay, so that's opportunity number two. The third opportunity relates to taxable income and trying to get some beneficial tax treatment on some of the income sources. Now, this chart basically has 3 sources of income listed. We have interest income, we have dividend income, and we have capital gains income. So this only applies in situations where, let's say you've got a situation where you've maximized in your RSPs, you've maximized in your tax-free savings account opportunities, and you have money within a corporate investment account or possibly a non-registered portfolio that you have personally. Now it's important for you to pay attention to how income is being generated from the portfolio. If you're getting interest income, then that's going to be fully taxable. So interest income is typically generated by government bonds, guaranteed investment certificates, high yield cash accounts, income mutual funds or ETFs, and that income basically has no tax advantages. It's fully taxable. You then have dividend income, and dividend income gives you a little more after-tax income that you keep. You pay a little less tax. What happens is dividends from corporations that are distributing dividends get some tax preference treatment. Canadian-controlled corporations, there's a dividend tax credit, and when you look at the overall tax rate on those incomes, there could be a little bit of beneficial tax treatment for you. So having some dividend-producing investments could be beneficial. And then you have capital gains, and capital gains would be the highest kind of net growth that you'd see, net income from the portfolio. So a gain would be basically you buy a stock for $10, it grows to $20, you sell it, you've got a $10 gain, and 50% of capital gains are then taxable. So that's the most beneficial stream of income outside of the tax-free savings accounts and RSP investing. Now, what's the downside to this? The downside really relates to risk trade-off. In other words, your lowest risk investments typically are going to be your interest-bearing investments. So it doesn't mean you shouldn't have interest-bearing investments in place. In fact, if you have a need for income from your portfolio, you want to be pretty cautious with any investments that may be required over the next 3, 6 months to 2 years. You may pay more tax on that income, but you have less volatility, less fluctuation. To get dividend income, you are going to take on a little more volatility because you get dividends from stocks, and stocks will fluctuate more than an interest-bearing investment or bond or high-yield cash account. And so that's the trade-off. It can still make very good sense for you to emphasize some level of dividends in your portfolio, but that's probably for investments with a time horizon going out 3 years plus. And then capital gains, if you're trying to squeeze out additional capital gains in your portfolio, it's common shares typically, whether it's big cap stocks, mid cap stocks, small cap stocks. For most investors, that might be through mutual funds or exchange traded funds that would buy those holdings. And that would give you the most beneficial tax treatment for your non-registered portfolio, but would also expose you to the most amount of fluctuation. So ideally, that part of your open account or corporate account would not be capital that you would need in the next 3-5 years. It's money you can push out in terms of time horizon, allow those assets to generate the gains that you're hoping for. If you see a surprise in the market, if you don't need the money right away, you can let the portfolio ride and recover so you're not selling anything off at a loss. So that summarizes how a retirement income plan can help give you some clarity around your tax planning. It's a really important part of retirement income planning. Number one, where are you landing on the tax brackets? Are there opportunities to exploit? Number two, how much income splitting should you be doing year by year in your retirement income plan? Your cash flow forecast in the plan will help you to give you clarity on that one. Number three, if you have non-registered investments or investments in a corporate account, what level of interest, dividend, capital gain mix should you be looking at to try to pay no more tax than is necessary on those assets? Anyway, I hope you enjoyed this video, and if you did, hit the like button. If you want to get future content, make sure you subscribe to our channel so that you're alerted to other content that we're posting on a regular basis. As well, we have links with this video that will take you to our resource page that talks about how to get a retirement income plan. We also have another resource that is basically a retirement planning resource with all kinds of video content, PDFs to help you in your retirement planning journey. And don't hesitate to click those links to access that content. Anyway, wishing you all the best in your retirement and wealth planning journey. You take care.